Right. Good afternoon and hello, everyone. I am Ragini Acharya, a partner in Husch Blackwell's healthcare group. Before we begin, I would like to cover a few housekeeping issues. At the bottom of your audience console, there are multiple application icons for your use during the program today. If you have any questions during the webcast, please submit them via the question box. We will try to answer all questions during the webcast today, but if a fuller answer is needed or we run out of time, it will be answered later via email. A PDF of the presentation is available in the program materials folder. Auto-generated closed captions are available for today's program. To turn on closed captions, click the CC button in the bottom right corner of the media player box. A recording of the webcast will be emailed to you tomorrow for watching and sharing. Toward the end of the program, be sure to complete our short survey. We use your feedback to plan future programs that are applicable to your business needs. That is all for housekeeping items, so let's get started with our program. Thank you for joining us for the second program in our Physician Transactions series, an informative three-part webinar series on important topics related to physician practice sales. Today's program will explore the common structures of physician practice sale transactions and outline the essential steps to prepare for a transaction. Joining me today is Todd Mello. With more than 3 decades of relevant experience, Todd is a recognized pioneer and thought leader in healthcare valuation and transactions advisory space. Currently, Todd leads Root Partners investment banking and transaction advisory practice. Prior to joining Root Partners, among other accomplishments, Todd co-founded a national boutique healthcare valuation firm, which he managed and grew from inception through its first 17 years of record growth. In addition to leading healthcare valuation teams at 2 additional management consulting firms, Todd's work for clients and attorneys is enhanced by more than 10 years of experience within the managed care, physician practice management, and investment banking fields. As I mentioned at the start, my name is Ragini Acharya, and I am a partner here at Husch Blackwell. I'm technically part of the Link remote office, but I live and work in the Denver office as well. I practice healthcare, regulatory, and transactional law, so I work a lot on the type of deals that Todd also does. So I want to turn it over to Todd now to begin our presentation.
Thanks, Ragini, and a pleasure to be here today with everyone. Our objective today is to really try to be as conversational as we can, try to make this interesting. I think, both Ragini and I have been on the other side of these types of presentations, both online and in person, and I always find it most interesting to listen to interesting dialogue and discussion as opposed to just sort of, tearing through a number of slides. So hopefully we're able to accomplish that today and make it informative and interesting for everyone. Okay, in terms of an outline today, we're going to start out with the initial transaction, and we're going to focus on 2 primary structures. There's a lot of interest among physicians in particular about how does a private equity transaction, how does it work, how is it structured, how do the economics, how are they generated? So we're going to go through some of that, and we have some numerical examples that we'll walk through, and Ragini will be providing some input as to some of the legal hurdles and issues that you should be aware of. We're going to talk about valuation as well. The second primary quote-unquote structure that we'll be covering today is really a purchase transaction involving a health system. It's a very different transaction. I have a lot of hospital and health system clients. So as I basically compare the 2 different types of transactions, I'm not picking on anyone today, but they are going to be very different. They're going to have different economics, and they're going to attract physicians who have different expectations and goals and objectives. And as we talk about structure today, as you may recall, if you had a chance to attend the last webinar, Ragini and Nick spoke briefly about structure as it relates to both stock and asset purchases. So I'm not going to touch too much on that, but I'm going to let Ragini touch on that in a moment. And then finally, we're going to go through 6 key steps that once you have a sense of how the transaction works, mechanically, we're going to go through 6 primary steps that you should be aware of if you're contemplating selling your practice or entertaining a transaction. Ragini?
Yeah, so to give a little bit more color to your point about asset versus equity transactions, I like to always give this example of going into a grocery store, attempting to buy a grocery store. So I always liken asset acquisitions to going to a grocery store and just cherry picking the items that you want. You know, you buy the apples, the bread, the milk, certain assets, but you leave behind things that you don't want, spoiled produce, or any, for example, liabilities or other legal obligations that you wouldn't want to take on. An equity acquisition is different in the sense that you're buying the entire store. So not just the apples, the bread, the milk, but everything, the shelves, the employees, the debts, the contracts, all of it. And so you're taking on the operation as a whole. Um, Anything you want to add to that, Todd? I think that pretty much
Yeah,
covers my distinction.
I think it's fair to say that most of these transactions are structured as asset purchase. Would you agree?
Yes, I would agree with that. I would say most of the transactions I've done in the context of physician practice sales are usually asset acquisitions. Part of that has to do with there being a CPOM doctrine, which I can touch on in a bit. But yeah, I agree with your statement.
Right. I mean, I'd contrast that to say, for example, the sale of an interest or in part or in whole of an ambulatory surgery center. In those cases, most typically, the buyer is buying an equity interest. So they are getting, to Ragini's point, you know, the good, bad, and the ugly, everything. And so
Yeah, absolutely.
That's when the lawyers have to spend a lot more time, I would suppose, and reps and warranties, indemnification, those other fun things, right?
Yeah, exactly. And to your point, exactly that is that different types of transactions should be structured differently, and there's reasons why you would choose one versus the other. You know, I've worked on a lot of transactions that are structured as equity deals, and those are again, you know, different than when you want to be able to pick and choose. So yeah, to your point, you know, ambulatory surgery center investments, joint venture investments by, you know, hospitals and physician groups, those types of things. But I think I think part of your presentation will probably get to that in a little bit as well.
Sure. All right, let's go on to the next slide. Let's get into the numbers, so to speak. Okay, what we're going to see here, hopefully folks could adjust don't ask me how, but the size of the graphic on their screen. But there are going to be 4 different elements to this slide that will appear as we have our discussion. So this is not the end of it. What you're seeing here, you will see, again, 3 more additional add-ons with different components as we explore this private equity MSO structure. So what I've done here is to create some illustrative numbers. It's not any specific practice per se. I made up some things. So you've got a practice with, say, $18 million of revenue. You've got, let's see, overhead of roughly, I'm trying to read my own slide here, that $9-point-something million, $9.9 million. And you've got essentially earnings that are available to fund various components of physician compensation of about $8.1 million. And you can see in my example that you know, the physicians are taking $750,000 of that are taken through some form of benefit, and another $7.3 million or so in compensation. And that could be a draw, it could be plus, you know, distributions of earnings at the end of the year, depending upon how the organization is structured. So, and there's just some key assumptions down there. Again, nothing particularly important other than I've got 15 doctors in this example with a $1.2 million of revenue each and an overhead of 55%. I will say that as we think about what private equity is interested in, this particular example is highlighting what I would call a platform acquisition. This is going into a market, for example, and acquiring the largest orthopedic practice, the one that, you know, everybody knows, the payers are all contracted with, the marquee practice. What we have seen just anecdotally last year and the last couple of years as interest rates have been higher is that a lot of the transactions, in fact, are taking existing platforms like this and adding in additional practices. We call them bolt-on or tuck-in acquisitions because the cost of capital has become much higher. But just it's sort of something to note. In this particular example, this is an example of a platform, an initial acquisition within a market. It's a fairly sizable business. The next step of this. Okay, so the way this works, there's another business that's set up here, and we'll get a bit into that in the next set of slides as well. But most typically, and Ragini mentioned the term earlier of CPOM, which is Corporate Practice of Medicine State. Ragini, before I get into the mechanics here, it might make sense for you just briefly to discuss why we would structure a deal like this with an MSO, and then we'll go through the funds flow.
Absolutely, yeah. So for those who aren't familiar with this concept, the corporate practice of medicine it's a legal doctrine that exists in many, many states. It prohibits simply, non-physician entities or corporations or laypersons from practicing medicine or employing physicians to provide medical services. It doesn't just apply to medical professionals. There can also be corporate practice of dentistry, corporate practice of podiatry, different types of professions. But what it really does at its core, it restricts corporations from directly owning or controlling medical practices so that you can ensure that the states are ensuring that the medical decision-making is being made by licensed physicians, and it's free from any undue influence that may come from a non-medical entity or group of folks that could potentially prioritize financial or business interests over the patient care. To get into, we have this description of an MSO. Management service organizations are entities that are utilized to get around CPOM restrictions in various states. And it's the business entity that will provide certain non-clinical or administrative or operational services. So the purpose of an MSO / professional entity model is to create a relationship where the MSOs allow physicians to focus on patient care while the business functions of the platform are outsourced to the MSO entity. Todd, I can get into a little bit of limited part MSOs, but we can also touch on that later if you think it'd be better.
Yeah, let's touch on as we get into the MSO set of slides. But so I'm going to take you back to elementary school with primary colors here. There's a reason why there's blue and red and purple here, because blue and red make purple. At least I think that's what they do. But what happens structurally is that all of the overhead, so we're talking about the staff, the non-provider staff. So typically the non-physicians, and depends perhaps, Ragini, on whether the mid-levels are included or excluded in that. And maybe we could.
Yeah, typically included in the practitioner. Okay. Yeah.
Okay, so they'd be part of the provider base.
Mm-hmm. Yes.
Okay. So in this particular example, I don't have mid-levels, but what we're doing here is saying, well, listen, historically you had a roster of support staff, you have supplies, you have occupancy-related expenses to your lease, et cetera, to run your business. That $9.9 million of overhead, you can see that I'm backing it out here. Doesn't mean it goes away. What we're going to see when we get to the MSO slides is that's going to show up over there as an expense. And what you see here is the other noteworthy component is the red adjustment, which I'm looking at historical compensation to the physicians of roughly $7.35 million. And then there's a $2.2 million, if I can read this correctly, over $2 million reduction in physician compensation. You can see on the bottom of the second column here, this percent earnings sold, sometimes referred to as a scrape. I didn't make that up, of 30%. What does that mean? It means that in order to create value to this practice, because historically practice is essentially zero at the end. It might take a salary or a draw, and then they're going to get the earnings, any available earnings that are left over at the end of the year, and they're going to distribute it to themselves. in this particular case, in this model, shareholder physicians are now going to take a reduction in compensation. And you're going to see what that creates. Essentially, it creates a bottom line. In this particular example, that reduction is equal to 30%, or I think that's $2.2 million. And the sum of that, what the physicians sold or gave up, plus the overhead, the 9.9 million, the red and the blue, is the value of the MSO fee of 12. So when we get to that set of slides, you will see that as revenue to the MSO, and then we will see that these overhead expenses still exist. And what's left over, at least on day one post-transaction, as income to the MSO, is exactly the portion that the physician sold of $2.2 million. That will become more clear when we get into the numbers. So here's another step in this transaction now. Okay, so as I mentioned, the revenue in this particular example is the same. The overhead and the amount of earnings that the shareholder physicians sold become now an MSO fee as an expense. And then the physicians in this particular example are taking a 30%, the shareholders, pay cut. So you can see that average compensation per physician pre-transaction on the left side was $490,000, and now it's $340,000. Now, obviously you get something in exchange for that. You're not just giving that up. And this is where the economics of the private equity model are really going to outshine from a purchase price standpoint, the economics under a hospital acquisition model, which we'll talk about. So here's sort of that final piece of the equation. You can see that, how do they determine the value? Here's a simplified example. So it's the earnings that were sold or given up by the shareholders of $2.2 million. In this particular example, I've used a 9 multiple. Could be higher, could be lower. I mean, multiples have trended downward in the last couple of years. The more marquee to practice, the more growth, the higher that multiple is going to be. It's not unusual to see those multiples in the double digits, low to mid double digits, sometimes higher, although I think those days are behind us. And then you can see that would generate a valuation of about $20 million in this particular example. Let's assume it has some debt, and then the payment to the doctors essentially would be roughly $18 million. Now, you can see here too, there's a couple of additional assumptions. 75% of that is taken in cash, and the balance of 25% is taken in what's called rollover equity. And essentially, I'm going to have Ragini touch on this in a minute. This is rollover equity in the MSO. Because of the corporate practice of medicine regulations, the private equity cannot own an equity interest directly in this practice, but they can own it in the MSO. So post-transaction, private equity will own in the MSO, and the shareholder physicians who sold will take a portion of their purchase price and own it as equity in the MSO, because everybody's essentially got skin in the game. Ragini, anything you want to add on to that concept?
Yeah, I mean, that's a really good summary of how it works, right? You take, the physicians will get their compensation as, say, for example, 80% of it in cash, and then retain 20% as rollover equity, either in the MSO or an affiliated entity, like the holding company of the MSO, depending on the transaction structure. But the real, I guess, purpose of this, and I think, Todd, you can attest to this in your experience, is that it serves as an incentive for the physicians to have an interest in the success of the practice under the new ownership and under the new management. And this incentivizes docs to continue driving growth and profitability. And ultimately, this is kind of a semi-long-term consideration, because the docs are incentivized to continue growth and profitability because they stand to benefit from what I think we colloquially call like the second bite at the apple, when the private equity firm decides to exit this investment, say either through a sale to another PE firm or to a strategic buyer. In 3 to 7 years, potentially, that's traditionally what we see. If they've helped increase the value of the entity, they'll reap the benefits of that down the road. Todd, I did want to ask you a quick question about your opinion on multiples and the internal and external factors that affect multiples and how they go up and down. Very broadly, what your thoughts are on that.
And multiples make good cocktail reception discussion. What's your multiple? What kind of multiples? In general, higher multiples, as I mentioned to you earlier, are going to be paid for businesses that exhibit more, a multiple has a growth rate implicit in its calculation. I mean, I would contrast that to, let's say you have a practice that really is sort of maxed out in terms of growth. There's not an expectation that there's more doctors that it's adding, more locations, more services, ancillaries, et cetera. You're not going to get the same level of multiple on that type of business. That might be a business that comes in after the fact. It's not going to be your typical platform initial acquisition in a market for private equity, because private equity, they want crazy growth. They don't want just, hey, let's grow 5% a year, 10% a year. They're looking to grow this thing, 60, 70, 80, 90, 100%, double, triple within that 3 to 7 year time frame. So mathematically, it is one of the methods that we use to value a company, a multiple of earnings. In this particular case, we use this notion of EBITDA is a term that perhaps most have heard of before, earnings before interest, taxes, depreciation, amortization. It is a measure or a proxy for cash flow, but multiples of EBITDA are sort of for these types of acquisitions, surgery centers, physician practices, for a PE deal, that is typically the currency that is discussed. Okay. Let's go on to the MSO, pick up a little speed here. All right, so now you can see what's happened at the practice. The practice continues to exist post-transaction, bills patients and payers and collects revenue, and essentially, keeps enough behind at the practice to pay the providers, and then remits everything else over to the, a lot of the other expenses are now at the MSO, but remits over essentially what's left to the MSO in the form of a management fee. All right, so here's the MSO in my example pre-transaction. In this particular example, it didn't exist. This MSO was established, contemporaneously with the acquisition of this platform practice. That's not always the case. Any bolt-on or subsequent tuck-in acquisition, the MSO is going to be in existence. Sometimes I've seen groups have separate legal entities that are MSOs. So it kind of depends, but just mechanically, I wanted to show you in this particular example. I think it's the easiest to see. So we have nothing prior to the transaction. Now, post-transaction, this 12.1 saw on the prior slides. And remember, in this simplified example, our overhead was $9.9 million at the practice, and it's still $9.9 million right after transaction. We'll talk about what happens in the future in a minute. And you can see that the income of this MSO is really equivalent to the difference between revenue, the assumed overhead, and what the physician sold the scrape, and that's the $2.2 million you see here. Now, as Ragini mentioned, it doesn't end there for PE. If that's all there is, they're not interested. So what happens over time, at least hopefully? Well, the expectation is that this grows. Now, the practice grows too, or there may be multiple practices all paying MSO fees. There could be, these other additional practices that are added over time, could be rolled into the existing practice. And I think, Ragini, you see it both ways?
Yeah, absolutely. I see a lot of, especially in my experience, is the just tack-on acquisitions. But yeah, definitely seen it all sorts of ways. So. Okay.
So again, mathematically, this is an example. You could see that, for example, 3 years out, the revenue of this business has gone from 12 to 21 million. Obviously, you're going to have more expenses. The income's gone up, but you've also needed to add some additional infrastructure. You're not going to get this kind of growth without better systems, more management, and those types of things. And so you can see that income in this particular example has almost tripled within 3 years. This is not, This happens. I mean, this does happen. That's what they're going for. And so how does this grow? How does this business grow from what you bought to where it is 3 years later? As I mentioned, additional practice acquisitions. You could have additional service offerings. Maybe certain ancillary services that historically were very costly. The physicians did not have the capital to do that. Now with the private equity partner, you're able to invest in those ancillaries. There's efficiencies, economies of scale. If I roll up 8 practices, and I don't need 8 administrators anymore. There's obviously other efficiencies. That's just one example. So there's redundancies that could be eliminated, and then other organic efforts. Clearly adding physicians and growing this business out. So this is what they're going for here. And mechanically, this is. It started as one practice, and over time it becomes a mega practice, if you will, with that. And it's this business, again, that the private equity and the physicians own an interest in. So the earnings of this business and the value of this business, went from a $2.2 million earnings number to almost $6.5 million earnings number in this example over a 3-year period, which means everybody's equity, all other things being equal, has just gone up substantially. Anything, Ragini, you want to add to this before we get to our next model?
No, I think you've covered it. I think that, really, really shows. I mean, this is the prime example, or like the, I'm failing on my word right now, but it's what they aspire to, right? This is like what ultimately the real goal of the PE firm is to achieve this. And not necessarily does it always work out this way, but right. Again, that's why, planning and planning is really important to kind of map out how these things will play out over the few years of the partnership.
Okay. Yeah, we'll get to, in our second half of the presentation, which will be coming up in a couple of minutes, we'll get into the, what do you got to do to get ready for a transaction and make this happen. But let's get on to the next type of transaction, which we're going to discuss, the second of 2, which is a transaction with a hospital. It's a lot more simple in terms of its structure. I have the same practice, hypothetical practice in this example that I had in the private equity example. Same practice, same overhead, same physician compensation. Now, again, I have lots of clients who are health systems. It's a very different model. You're not going to get a huge purchase price on this type of deal. You can see down here that most of the deals that I'm seeing with health systems these days, the health system's not paying a big multiple of earnings. Why? Because there are no earnings. Why? Because most physicians who join a hospital, become employees of a health system or one of their subsidiaries, are looking to maintain or increase their compensation post-transaction, subject to fair market value constraints. As you may recall from the prior private equity model, physicians in that particular case took a pay cut, at least in the short term. Obviously, in the long haul, they expect to have, through the growth initiatives and efficiency we talked about, they expect to have their income go up, and they also expect to have their equity worth in the MSO worth more money, and obviously they also got a big chunk of money up front. So it's a very different model. And again, it's not right or wrong if you're interested in one versus the other. Just know going in that you're not going to get a huge multiple for a deal for health system. Yeah. Traditionally, again, I haven't seen it. Ragini, did you have something on this?
Well, I was just going to say, to your point, for most health systems, their offers will have a purchase price that does not include any rollover equity, and it's entirely funded by cash. In thinking about pros and cons and why physicians would want to go one way or the other, this sometimes may be seen as advantageous for physicians who are a little bit more cautious or uncertain about the future and don't entirely want to take the risk associated with the rollover equity. And so they can potentially, and let me know if you disagree, but I think that hospitals can offer significantly more cash, which can be a competitive advantage, but they don't offer that same potential for growth. And so, depending on your overall life outlook and how you approach, risk adverse versus risk tolerant. That's something to take into consideration when pursuing these types of deals.
Yeah, I mean, I want to clarify on the cash. When you say they can offer more cash, traditionally on the employment fund, right? As opposed to upfront. Mm-hmm. You're not going to get a huge purchase price from, again, the typical hospital deal. I haven't seen one in a while where a hospital did that, but you are going to get higher income. And I think one of the important things to think about here is that perhaps one of the criticisms of a private equity deal is that the health system and the physicians, depending upon the age of the physician, of course, are in it for the long haul. They've been in the market for, maybe this practice has been around for 50 years and it's just sort of morphed over time and added new shareholders, and folks have retired, folks have been added, and it's sort of it's a going concern practice serving the community. And similarly with the hospital is going to be in the community, into perpetuity, theoretically, and the two together are obviously necessary components in delivering quality healthcare in the marketplace.
Sorry, go ahead, Tom. I think that's entirely right. And, there are other advantages I think about from a regulatory perspective, particularly in states that have, that are certificate of need states, certain ancillaries like ASCs or labs or anything like that, they can't be built unless they're through a health system, for example, because of a moratorium or something. And so physician practices, may be precluded from expanding into those areas unless they partner with a hospital or a health system.
Yep, exactly. Again, there are pluses and minuses. It's really going to depend upon the objectives of the physicians, and we're going to get to that in a minute. And you can see this particular example as we wrap this slide up. Again, not a big purchase price, really. It's just purchasing essentially equipment. That's typically what I see these days. But typically, physicians, again, subject to fair market value opinions, of course, are seeing an increase in compensation, as you can see in my example. Sometimes the overhead does tend to increase. Not always. I'm showing that. And then actually, I'm showing in this particular example a loss at the practice level, which again is not in and of itself, does not suggest that something's not fair market value just because of the loss. Clearly the hospital, economically at least, there's other, the referrals of this group to the hospital are generating revenue and income elsewhere in the hospital ancillaries, bed days, whatever else. Could be surgery centers, depends what's owned, etc. So it's not as if hospitals just want to lose money, but many do at the practice level. But where they make it up, at least economically, is essentially the holistic nature of the relationship and the referrals. But of course, for compliance reasons, health systems cannot value the practice based upon all the downstream, referrals, et cetera. Anything on that, Ragini, before we move on?
No, I think you hit the nail on the head there. I think that's exactly right. That is a lot of the value is in that the access to that referral base, but yeah, whether or not you can count it that's a completely different question.
You can do your calculations and spreadsheets, you just don't pay on it.
Yeah.
Okay. All right, moving on now. Now you've hopefully got a good sense for the two more common structures that we see these days. Now we're going to get into what are the 6 steps. We'll pick up a little bit of speed and we'll get into the 6 steps of preparing in the event of a transaction. And in this one, I'm really focusing, it's applicable to the hospital, but I'm really focusing from the perspective of somebody doing a private equity deal. Okay, so first step is, goal and objective review and alignment. So what are you trying to accomplish? Why, if I'm representing as a banker, a group of physicians, why do you guys want to, why do you want to do a transaction? And you might hear different answers. Again, it's not a one size fits all, but unusual for physicians that are closer to retirement to be thinking more about the purchase consideration, as opposed to those perhaps that are newer or somewhere in the middle of their their career that are saying that, listen, I'm in it for the next 20 years. I want a partner who has expertise and capital and can help me take my practice to the next level. I think that's what's best for me. But we've got to sort that out. And that's also going to have implications on what type of buyers. You know, again, if my, and I've had this happen, if my client is saying, listen, I really want to be part of the health system for a variety of reasons, then, you know, I'm not going to go shop it out to private equity. We're not even going to go there. I mean, it's nice to have options, of course, and we would like to show our clients, you know, what are the economic, basically implications of these various alternatives. But we got to set that, you know, we got to determine that on the front end, or else you're running a process that is sort of, you know, without direction. Anything, Ragini, you want to hit on that?
Yeah, I mean, I think you and I have talked about this and getting, you know, sellers on the same page, right? Like what, and there are some things to think about. And I think we harped on this during our last presentation as well. There are a few tips I would have. One is, you know, making sure that all of the stakeholders are being engaged. And, you know, you understand what the desires are from both, you know, your junior physicians versus the more senior ones, you know, that are looking to leave. I think it's really important to also think about, you know, not just the transaction itself and immediately post-closing, but what the goals are post-transaction for a few, like several years out, you know, and potential exit opportunities in case you want to, you know, leave the partnership or the platform. And so having those conversations amongst the entire group and understanding where everybody is, so you can know whether or not you're actually on the same page, like slightly off the pages, maybe on two adjacent pages. I think those are all really important conversations to have.
Yeah, and I will say this: if the bulk of the group is looking to take the money and, you know, retire, private equity is not going to be interested in that transaction. Doesn't mean that everybody in an entire group needs to feel that way. No, I mean, but the most of the physicians need to plan on hanging around at least 5 years. If there are physicians that are closer to retirement, those issues are typically sorted out, negotiated on the front end. But I think a good rule of thumb is to expect that if you do this and you want to retain your purchase consideration, that you need to plan on being there at least 5 years. Again, it's a sort of general rule, but there may be exceptions. But it's not our just, hey, take the money and go to sleep strategy.
There are other, I think to your point, Todd, there are other things to consider besides money in terms of incentives, right? So if you have a group of physicians, you know, there are other things that you could potentially offer to incentivize folks to stay on, you know, leadership opportunities, you know, potential, I give this as an example, like teaching affiliations or other clinical innovation roles. You know, we've seen a bunch of different examples in our practices of how to incentivize folks to stay beyond that retirement stage. You know, for the folks that are looking to make the exit, you know, how do you get them to stay on? Well, you know, what are the cards that they want to play? What are you willing to give up from your side? So yeah, it's all very, I think, transaction specific.
Yep. Okay. All right. So that's the first step, and next key step is essentially crunching through all your data. I mean, that's what we bankers do. Part of that is coming up, as we'll talk, with forecasts and valuation, pricing guidance. We're going to get to that in a couple of minutes, but essentially, this is an area where bankers spend a lot of time, because what we're trying to do is prepare to tell a story about your practice. We produce a very comprehensive book in most cases if we're going to talk to numerous buyers. We have to have a deliverable to send them. And we need to be prepared to tell your story. Now, it's not uncommon that if we just took your financial statements as reported, that there may be things in there that aren't representative of the practice. You know, cash basis financials, I think just suffice it to say that you're recognizing revenue, when the money's collected, regardless of what the data service was. So if for whatever reason you had a $2 million receivable that was sitting out for 3 years and you all of a sudden collected it in 2025, that's going to show as revenue financials under 2025. A one-time thing and distorted your financials, and that can go both ways. That's going to be important to know, because I assure you that any private equity buyer is going to do what's called the quality of earnings analysis, where they're going to go through your revenue. And if you're not on a cash basis, they're going to do what's called these waterfalls, where they're essentially going to restate your financials on an accounting or accrual basis, which means that in that example, that $2 million of old receivable would not have been included in your revenue for that particular year. Also, there may be COVID relief funds. There could be things like, well, let's get into some examples here of the process we go through. So we look at your historical data, and then we have to see if there's any compelling arguments to adjust it. Okay, here's a simplifying example. I have a practice with $10 million of revenue. Again, no earnings in this particular example because the shareholders take all the money. But let's just say that I'm looking at your 23 financials, but in August of that year, you actually opened a new office. And so for 2023, we didn't have a full 12 months of that office being opened. But if we were to run that out for the next 12 months, we would see that. So things that we want to point out and adjust for. And you could see here, and that would also include, that impacts, if you open new offices in this particular example, obviously you're going to have more expense in staffing, you're going to have more occupancy and, supplies. And you're also, in this particular example, you might have needed to add new doctors mid-year, but it's not a full 12 months of expense. So those are the types of things that we would work closely with the seller in identifying. In this particular example as well, maybe there was a lawsuit that we spent more money on attorneys that year than you normally do. We would adjust for that and explain it. And similarly, maybe there's some perks that the shareholders are taking, the dinners and the travel. We're not the IRS, but those are the types of things that would not be incurred on a go-forward basis. And so we're going to adjust those out. So you can see in this particular example, how a $10 million revenue practice with no earnings goes to a $12 million revenue practice with $1.1 million of earnings, based upon us understanding what's happening in the business and making the appropriate adjustments. This is critical because this orange color here, you're going to see it again. I'm big on colors today. This is the starting point, the jumping off point to create projections. And we'll talk about that in the coming slide. This is a very simplified example, but you'd be shocked as to how much work and time we spend doing this. Ragini, any thoughts on this?
I'm just glad it's you doing that and not me.
Fair enough. Okay, let's keep moving. All right, as I mentioned a minute ago, the normalization of what's happened historically is necessary because we're going to use that as a foundation from which we're going to make projections. Why? Because if somebody is buying your practice, they're not buying what happened back in 2022, 23, 24, up until the point the transaction closes. They're buying an expectation of future revenue and earnings. And so they want you to put together, as part of what we would typically do in this confidential information memorandum, this SIM that we would use to help shop your business, your practice. We would show the historicals, we would show adjustments, we would tell you a story, we'd hit on qualitative and quantitative measures, but we also would present a set of projections. Now, this has got a lot more discipline lately. I mean, it used to be the case, hey, well, I've got a wild idea, maybe I could do this in the future if we don't do a transaction, so I want you, buyer, to give you credit for that. Now, people are a lot more discerning and critical of projections. I think that the easiest way to think about it, and here's an example. Remember the orange from the prior slide, same numbers, folks. Here's a business. I'd say, okay, this is what I'm putting in my book. I got a bunch of footnotes, usually explaining what I'm doing. But my business, and this is important, in absence of a transaction, this is not a practice. Once it does the transaction that the private equity needs to help, this is what your plans are. They have to be more than just, pie in the sky. Well, we might do this. One day we might do that. These are things you're going to get credit for, things that are initiatives that are underway, whether or not the revenue or the earnings have shown up in your financials yet. I mean, 100% credit? Probably not. But you are going to get, if you're adding doctors, and for example, I want to add doctors and I haven't found any yet, is a very different statement than I just signed 2 physicians from fellowship and they're scheduled to start in September. So this has to be realistic, or else people are just going to ignore it. I mean, Ragini, any thoughts on this?
Yeah, I think the documentation of strategic planning is incredibly important. I mean, I think you're hitting the nail on the head there, right? Like, and this all kind of goes back as well to what Nick and I discussed a couple weeks ago, in terms of preparation, so that you're ready to sell when you want to, when the timing is right for you. And so if you're lining these things up ahead of time, you can prepare yourself to sell, in a couple of years. And if you have these plans laid out appropriately and properly, then buyers will be more interested.
Absolutely. And it keeps momentum on. That's what we'll talk about. Okay. Next major step, we've alluded to this earlier. I think it's reasonable to set some expectations on the front end to the selling shareholders as to what we think, based upon other recent similar transactions, that their practice may sell for. If everybody's going in because somebody 4 years ago got a 20 multiple and it happened, I'm not going to set my clients' expectations at a 20 multiple. I think that, let me put it this way. If your business is $1 million of EBITDA, last year end, and you're trending for a full 12 months at $2 million, if somebody pays you a really high multiple on the $1 million, I mean, effectively from the buyer's standpoint, they're really, if they give you a 12 multiple on $1 million, they're not really giving you a 12 multiple, because you're already underway to be having your earnings essentially increase beyond that $1 million. So that effectively, from the private equity's perspective, they're not giving you a 12 multiple. They're giving you something less than that because your business is already trending up. So multiples are usually there's a lot more math between valuators and private equity, what they do behind the scenes, but most typically when you look at a term sheet, it's gonna talk about, it's gonna be your normalized earnings subject to diligence. Basically what you told us in that book, that sim that you gave us, assuming those numbers didn't change. Here's your multiple, here's our purchase price. Now we're gonna go under a letter of intent. And by the way, we're gonna conduct a bunch of diligence and that number can change based upon what we find. And Ragini, anything to add on that?
I think with respect to diligence, I think, again, it's really important to prepare and take stock of what might have happened or what might be happening and have those matters cleaned up so that it doesn't negatively affect what your multiples are going forward. If you have a good compliance system in place, or, good like internal auditing process that can go leaps and bounds, and that can help give buyers some assurances about about the practice going forward, and not scare them off. Frankly, I think that's a really big concern from the regulatory side.
Yes, so we're going to talk about this concept in a moment here. I call it messaging. So these are basically what we're just talking about. Is, let's think about it. I mean, there's sort of two major ways to do this, right? At either end of the spectrum. Hey, let's go sell our practice. let's start talking to people today, buyers, whether I'm using a banker or not. See, a banker's not going to let you do that unless you're prepared, or a good banker. But let's just say that, I've had clients that say, well, I've already had 3 conversations, just throw them the financials. Well, wait a minute. We've got to go through your financials and clean them up. We need to understand, make sure we tell your story. So backwards, right? I'm going to start talking to buyers, and then we're going to figure all this stuff out once we're underway. This is super sophisticated, and my management team is top notch. When you get into it, I can't produce any information that you asked me for. Information on my produce it, because I don't know how to get reports out of my billing system, or my financials are a mess, and make claims of how sophisticated you are and why you deserve this big multiple if you essentially are letting any buyer see some of these gaps before you're ready. It's like trying to sell a house before it's staged and ready to go. So I think to Ragini's point, you're much better off when starting a process earlier, identifying your gaps, doing what needs to be done, fixing them, and then before you go out to market. And then again, from a messaging standpoint, I can just tell you that buyers are very impressed when they ask for lots of information, which they will do, and all of a sudden the practice turns it around, within a fairly short period of time, and the information's in good condition. So, Ragini, anything you want to add to that?
I think that's exactly right. These are, and we touched on this in our last presentation about, the types of things you need to be doing in terms of this gap analysis. So I won't reiterate them here, but I think you're exactly right. Like, the diligence is a really crucial portion of preparing.
Right. And if you think of what your banker asks you to do is annoying or too detailed, or taking you a lot of time, once you get into diligence, the gloves come off. I mean, it is a different level. So the better off being prepared. Okay, at the end, all this is going to culminate, in a well-run process as to, hey, we've gone through this process, so you engage your banker early. We've normalized the financials. We've created detailed projections with explanations. We have supporting documentation. We have supporting documentation to all these personal expenses we ran through the business, and these whatever adjustments if we made anything to revenue. To Ragini's point, we have our legal documents in order. We're not going to be scrambling around. Things are up to speed. If there's coding compliance issues, or you think that might be an issue, is to go through that on the front end before you get somebody involved. And so it all sort of culminates into a plan. Now, I would say this. We've got a few minutes left here. At one point, you've got your graphic here. This is a marathon. I mean, this stuff can take 12, 18 months. I mean, I haven't seen one go in 6. I mean, in smaller practices take just as much time, perhaps more sometimes, than larger practices due to sophistication of data and those types of things. So just know going in that it's going to take a bunch of your time if you're the managing partner of a practice, your administrator's time, your accountant. At this point, you want to retain competent advisors. It's critical. I mean, I think banker earlier, but at some point, along the way, clearly legal, because there's going to be legal diligence streams, HR, financial, revenue, all sorts of stuff. And it is not for the weak of stomach. Now, it can be very, very, beneficial at the end of the day when when the transaction closes, but getting there is a bit of work. I don't want to mislead on that.
Yeah, I think that's a really good point.
So that's all I had on the. I know we only have about 5 minutes left, but I don't know if there's any questions or anything you want to add, Ragini?
No, I think we really hit everything that I wanted to talk about today as well. And thank you for going through those charts. I will say I'm so glad that it's you that handles those numbers and does the analysis rather than me that has to do that analysis. I don't see any questions in the question box at this time, but I'll just give another few seconds in case anybody has any that they want to populate. We're also completely happy to answer any of these questions offline. So if you want to, I think our contact information is included as part of the presentation materials. So to the extent, there are questions after the presentation, feel free to contact me or Todd. Otherwise, I think that concludes our substantive portion of our presentation. Anything else, Todd, you have?
Yeah, it's been a pleasure, and I hope people found it interesting and informative.
Yeah. All right. Well, in closing then, thank you all for joining us today. We hope this information was helpful to you and your organization. As a reminder, a recording of the webcast will be emailed to you tomorrow for watching and sharing. Please be sure to complete our short survey. We use your feedback to plan the future programs and prepare you for your applicable business needs. So, and please also be sure to tune in for our final program in this series on March 5th, Succession and Sale Planning for Practice Owners. That will be hosted by Scott Casper of 8 Quarter Advisors and Brad Godomsky from Bernstein. Again, thank you, and that concludes our webinar.
Thank you.